Hi everyone, good morning. Thank you for joining us. Pleased that you could be here today for this session. We'll be looking at avoiding greenwashing in environmentally friendly portfolios. We're really pleased to be working with our friends at Scientific Beta on this session. I think it'll be a really interesting one. Just to say firstly, to introduce myself, for those of you who have not met before, my name is Karen Hurst. I work in the PLSA's policy team, so I spend a lot of my time looking at issues around investment and certainly on greenwashing and other such environmental themes. I'll introduce our speakers just in a second, but just to give you some background, as we all know, the year ahead is going to be a somewhat eventful one when it comes to looking at the environmental impact of our portfolios. We all know we've got TCFD on the horizon. We've also got expecting the sustainability disclosure requirements to come into force at some point in the near future. So this session will be looking at designing portfolios that ensure the whole portfolio reflects the aspirations and the wishes of trustees. As we all know, this can be a somewhat complicated issue. So hopefully today we'll have an opportunity to sort of flesh out some of those concerns. We are live today, so if you do have any questions or just any comments, do feel free to pop them into the chat box. I know that our speakers have got a lot of information to get through, but we will make as much time as we can to work through those. So we do welcome them. We will have a poll question later on as well. So with that, I'm going to hand over to our speakers. We're pleased today to be hearing from Eric Christensen, who's an ESG and low carbon investment specialist at Scientific Beta. And firstly, I'm going to hand over to Felix Goetz, who's the research director at Scientific Beta. So Felix.
Yes, thank you, Karen. So climate investing has seen a lot of attention from investors and product providers. And we're really focusing here on the question of the real world impact of these strategies. And so just to think about real world impact, it's useful to actually recall the different objectives that investors have with climate strategies. And so if you think about the objectives, there's actually very different objectives. So having a positive impact, basically means that with their capital, investors actually want to do something about emissions, and that's one important objective. There are other objectives that investors may have, and they may be obviously reasonable objectives. So, for example, investors could be more modest and say, well, they simply want to align their investments with their values, right? So maybe they're not actually going to change emissions in the real world, but maybe they will feel good about actually not holding the very brown companies or the stocks of these companies. Other motivations are more monetary objectives. So, for example, you may want to avoid exposure to climate risk. So the idea is not to do something good for the world. Simply, you want to not take on risk for yourself. And another objective that investors may have is to generate alpha. So, say markets don't really understand that climate risk is an issue, and so they may underprice this. Then you could try to generate alpha. So there's a lot of objectives, and obviously, your strategy or your optimal strategy may look very different depending on what your objective is. So we focus really here on one motivation, which is this question of impact. And we're trying to ask, do current investment practices in climate investing actually allow for that impact to happen? So that's our question. And to actually address this question, it's important to think about how this impact can actually occur. So I'll make a very obvious statement. Investors actually do not have any direct control of how much companies emit. I think that's just important to recall, because sometimes when you see these discussions about emissions of a portfolio or temperature of a portfolio, we should understand that portfolios don't emit carbon, and investors cannot actually directly control how much emissions are being how much carbon is being emitted. So they're really after an indirect impact. So we need to have a clear idea of how can that indirect impact happen. So what's the mechanism by which investors can have impact. So there's three different mechanisms. The first one is capital allocation. So if investors have less demand for brown stocks, then you would expect that the price of brown stocks will actually go down. There's less demand, and that also means that the cost of capital of these companies will increase, and the the supply of capital to these companies will actually decrease. So they will find less profitable projects, and so that will actually mean that these very brown projects will have difficulty being financed. Another channel is engagement. So investors can have discussions with companies and try to push them to change. So this could happen, for example, if an investor is not actually invested with a company, he could still actually exert some pressure by having discussions, and the company will understand, well, this large pension fund, for example, is never going to be a shareholder if we don't change. Or it could be a current shareholder who puts pressure on the company. So these are two main channels. You could also think about kind of policy influence of investors. That's something we're not going to think about much further here. So we'll focus more on the channel of engagement and also the channel of capital allocation. Now, when you think about this impact objective, so a question you can ask is, well, are there not portfolios and investment products that pretend to have an impact, but don't actually have this impact? And there may be no good reason to believe that certain portfolio strategies will have an impact. So we refer to this as portfolio greenwashing. So portfolio greenwashing to us is using a portfolio construction that creates a green portfolio, but basically doesn't fulfill fundamental criteria for having an impact. So this is similar to greenwashing of corporations, where they pretend to have products and practices that are very green, but actually they don't really they're not really greener than the average companies. And this is something that, so this problem in portfolios has been highlighted recently. So for example, John Cochrane, who's an economist at Stanford, he basically argued that when asset managers make claims about their portfolio being virtuous, maybe we should hold them to high standards in terms of actually documenting that this virtue actually exists. And maybe there should be legal implications if actually investment managers pretend to actually be virtuous when they don't actually have real impact. And so if you look at the current situation here, it's clear that lots of portfolios and products claim to have impact, but it's not really so clear how you measure that. So you sometimes have very naive measures, as shown here, that you say, okay, the portfolio avoided so many tons of CO2, but if a company avoids tons of CO2 and you're holding shares of that company, it doesn't mean that you actually contributed to that avoidance, right? So the question you have to ask is, well, what would have happened if I hadn't invested in that company? And the answer could well be, well, the company would have, still avoided a lot of carbon. And so the question is really, what is the impact of the actual investment? And so this is really an important question. And we actually try to identify a set of criteria to see what is actually a reasonable strategy that could have impact. And so I'll explain these criteria in more detail. Let me just go to explain to you a bit how we're looking at this question. So the way we look at this is really to find some evidence on greenwashing and problems with supposedly green portfolios. The question is, how can we do that? So it'll be very difficult for us to do that looking at data of actual funds, simply because a lot of these funds are very recent. Okay, if you just look at ETFs, for example, the dedicated climate ETFs are quite new. We may have problems with data access, especially for historical data. And you can argue also, and you can debate about what is a climate fund, what is not a climate fund. So kind of we actually did the work and went to some fund databases. And if you say that you're looking at all funds that have a climate objective, you get a list of funds, but you find some very surprising results. So you have the a problem of classification. And so ultimately your result may depend a lot on how you classify these funds. And so what we did instead is we actually went to the stock level. So we looked at data of individual stocks, and we looked at data on climate metrics for these firms, and we constructed strategies that correspond to common practice in climate investing. So we used commonly employed weighting schemes, and we used quite common climate scores to actually design these strategies. And we came up with different types of strategies. So there is two broad strategy types. The first type we call it tilt strategies. So this is, you start with market cap, and then starting with market cap index, you're just going to tilt the portfolio by a green score. So this is a very common methodology, for example, to build indices and ETFs. So the first version of this, so we call this T or tilt strategy. The first version of tilt strategies only looks at a climate score. The second variation of these tilt strategies also considers other ESG objectives. And again, that's quite common. Climate investors quite often, well, they have some non-financial objectives, and quite often they also care about other dimensions than just the climate. So they may care about things like employee and labor rights, product safety, etc., these kind of social issues. And so quite often you see that the ESG scores are used in addition to climate scores. So that's our type T2 tilt strategies that mix in an ESG score. And we're also looking at a second broad class of strategies. We call them optimized strategies. So what you do here is you're using the same climate scores, but you're going to minimize tracking error with respect to a market benchmark, while improving the climate score relative to the market benchmark. And again, we have the first variation and the second variation. So let's say one has only climate objectives, and the second variation has mixed objectives, both climate and ESG objectives. So these are the strategies that we construct. And so this taxonomy is, let's say, valid more generally. So you could also use this taxonomy of tilt and optimized and climate only versus climate and ESG objectives to actually classify existing indices, for example, climate indices. And so this is important for us because what we want to do is we want to actually design stylized strategies that capture the common portfolio mechanisms that are actually used in the industry. So in particular, what do we do? Well, we use a developed equity universe. So this is quite a standard universe of large and mid caps in developed countries. We then use different types of climate scores. So our basic score that we think is the most relevant is intensity, measured as CO2 or greenhouse gas emissions divided by revenues. So that gives a good measure of how much negative impact a firm has on the climate per unit of revenue. But we're also looking at different ratios, like, for example, emissions divided by definition of enterprise value, and other ratios that are used in practice. We're also looking at different scopes. So we have one specification where we're just adding scope 1 and scope 2, and we also have one where we also include scope 3 emissions, because investors may differ in terms of their practice. Then we also mix in an ESG score, and we're going to evaluate these strategies, each strategy with respect to the target score, right? So when we're going to look at any result for the strategy that uses, say, total emissions divided by revenue, we're going to always judge it in terms of how it behaves with that target objective. And so first result, which is quite clear, is that all of these strategies lead to a dramatic reduction in portfolio level emissions. And that's actually the thing that is talked about most often by product providers. So for example, if you look at the tilt strategy that doesn't have any ESG objectives, you actually reduce the carbon intensity by more than 80%. Okay, so that seems like a very green portfolio. Now we're going to ask this question, well, this is like a headline result. Okay, so this looks green, but is that actually going to lead to impact? And we're going to look at some finer criteria that can tell us something about consistency with impact. And here are the three criteria that we look at. So the first one is we look at, well, are the key sectors of the economy perhaps severely underrepresented in a given portfolio? So that for us would be reason to say there's some inconsistency with an impact objective, because I could look very green by, for example, investing heavily in something like water utilities. So if you provide households with water is not being transported by plane and not by trucks, so you don't emit a lot of carbon. It just goes through pipes, and it's kind of difficult to see how you would be very harmful for the climate if what you're doing is you're distributing water to households, right? So if you simply overweight such a sector, and then you overweight another sector, like say electricity, well, then you're not actually going to have a favorable impact on companies within a sector such as electricity, nor are you going to have an impact really on companies within water. You're simply underweighting one versus the other, and this would lead to a underrepresentation of a sector. So the key idea here is that by looking at by simply removing sectors, you're not going to actually discriminate among companies in terms of their value added. So I can have a company that is a little bit brown, but that is in a sector that just very heavily relies on carbon emissions. And this company may just be a little bit brown because it's actually doing a lot, investing a lot in technology to slowly get better. So say an electricity company that is moving from let's say using fossil fuels to actually using renewables. Well, this company actually needs to invest. So your objective shouldn't be to divest from that company to increase the cost of capital of that company, right? You should actually discriminate, and there could be companies that emit still, more than average or more than green stocks, but have a value added because of their sector. So we're looking for underrepresentation of key sectors as a diagnostic of an inconsistency. The second criterion is very simple. So let's look at what happens with stocks that become browner over time. So a stock that increases its carbon intensity, for example. Now, if you want to send a signal to a company, you clearly would not want to increase your allocation to a stock that has actually become worse in terms of climate impact. So we would see a strong inconsistency if stocks that deteriorate in terms of their climate performance, climate friendliness, then actually get increasing weights. And so we're going to assess that question. And the final question, perhaps the most obvious one, is we're going to be interested in how much of the weights are actually driven by this climate score as opposed to other characteristics. And again, if climate strategies, just mostly resemble, standard, let's say, cap-weighted indices or standard investment strategy that really don't even try to integrate any climate information, we would see that as a sign of inconsistency. So these are the three things that we assess, and I'll just briefly show you the results for each of them. So the first question on the sector representation. So here, as an example, you see electricity, and you see the active weight in that sector and the relative underrepresentation. So you can see that these strategies, okay, if you look at the ones that look at climate scores, they actually reduce the weight of this electricity sector by something like 80 to 90%. And so that will make the portfolios look very green. But of course, the question in the real world is, what are we doing with electricity, right? So we can divest and severely underweight electricity stocks, but people will still need electricity. So maybe the question is not to reduce the sector. Maybe the question is to account for the differences of different companies. So you get this very severe underrepresentation. And just to kind of illustrate the inconsistency of this, we just have this illustration here of a kind of economy that could work without electricity. So what you see here is obviously pretty green and low carbon. However, we think that in real life, most people would not go to this kind of measure in real life. You would still want electricity that you don't generate yourself, but or power that you generate yourself, but you would want companies to actually innovate to come up with something where you can press a button and the washing machine still runs, and that obviously requires investment. So divesting from these essential sectors really isn't an answer to to having impact. So that's the first result. Now, the second issue that we're interested in is this question of deteriorators. Okay, I'll just skip some of the details. So this question of deteriorators is, I think it's a pretty simple criterion. So what would he expect a climate investment strategy to do when a firm actually deteriorates, when the carbon intensity rises over time? And of course, just keep in mind that the kind of the usual idea we have is that emissions will actually have to decrease quite regularly by something like 8% per year, and then to finally by the middle of the century reach a condition where there's no emissions on a net basis. So clearly, firms that increase their carbon intensity, they're not the ones that you want to endow with capital. And so we just ask this question: well, what happens to the climate strategies, and what happens to the stocks when they are deteriorators? And what we observe is that, well, what happens to these stocks? Well, there's two things that can happen: either the strategy increases the weight in that stock, or it decreases the weight. And what we see is that in about 1/3 of the cases, these deteriorators actually get an increasing weight. Okay, so if you have 100 deteriorators, about 1/3 of them will actually see an increase in their weight across these different strategies. And the problem with that, of course, is inconsistency of the signal that you're sending. So there are discussions, for example, among investors that companies should actually link part of the manager compensation, the executive compensation, to actually reducing emissions. And so that's clearly to give incentives to the manager to act. And so likewise, if companies want to obtain capital and they entertain investor relations, and then on the one hand, investors tell them, well, we're really worried about the climate, you should actually work harder, you should do more to reduce emissions. What the company does is the opposite. The company actually gets worse. And then these strategies, quite often will actually, as a result, increase the weight in these companies. So that obviously sends a completely inconsistent signal to these companies. So this is, I think, something very basic. So you could, imagine, for example, let's say a rookie basketball player who's starting off in the NBA. The coach tells him, you have to pass the ball more because otherwise, it's not the right thing. And the guy does the opposite, so he passes the guy less often, and the coach gives him more minutes to play. And so what's the player going to conclude? Is it's going to conclude, well, I'm getting actually rewarded, even though I didn't actually do what I was asked to do. So the next time the coach sends him a message, he's probably going to ignore it, and you have the same, clearly the same problem here. And the problem is quite pronounced. Now you could still think, okay, what we're looking at are very stylized strategies, right? So we just created, them by applying this tilt methodology, or this optimization methodology. So perhaps in practice, actual product providers, have something in place to prevent this from happening. We looked through different sets of index methodologies, and actually what we found is that none of the index methodologies we looked at actually have any explicit mechanism that would guarantee that this problem doesn't happen. So you could think about something quite simple. As soon as you detect that a stock deteriorated, you can maybe put a cap on the weight. So indices worry a lot about all kind of liquidity rules, and they do all kinds of adjustments to ensure liquidity. Well, maybe we need also to think about avoiding this problem with deteriorators. Now, this result of deteriorators may seem surprising. So how can it be, if you have climate objectives, that still you're going to increase the weight in the companies that worsen and deteriorate on that dimension? And so the question is also, why does this happen? And the simple answer to this question is, well, simply the climate score hardly matters in climate strategies, right? So you could think that if you look at a set of weights of different stocks in climate strategies, and you see one stock has a very high weight and the other stock has a very low weight, okay, it must be that one stock is just much greener and the other stock is much browner, right? So what explains how I invest should be these climate considerations. Well, it turns out that that's actually not true. So the main thing actually that influences these climate strategies has nothing to do with climate performance. So the main thing that influences the weights is the classic kind of standard financial characteristic, which is the market value of these stocks. And then if you mix in ESG scores, these ESG scores also become very important. So a firm may do very well on labor relations, right? So a lot of fossil fuel companies probably may treat their workers quite well. They're often profitable companies, and so they can afford to do that, and they may actually have high ESG scores that counterbalance the poor climate scores, for example. And so this is really a kind of very clear finding if we look at what actually drives the weights. So the climate only accounts for something like 12%, if you express this in percentage terms. So about only about 2 basis points of the weight of a stock are basically explained by the climate score, and about 13 basis points are explained by market cap. So kind of market cap actually drowns out the role of the climate score. And so the clear result from this analysis is that what climate, or how you invest with climate strategies, is actually not so much about how green or how brown a stock is. It's really more about how any cap-weighted strategy would invest in these stocks. And so there's really very little influence of climate scores. And what we find surprising is that there's so much discussion about what is the right score, right? So providers try to come up with more and more elaborate ways of measuring this climate score. Of course, it's reasonable to ask these questions, but if you're going through all this work and you make all this effort, and in many times you pay all this money and fees to get these very fancy and very advanced climate scores, well, if in the end that only accounts for about 10% of the portfolio and 90% is just driven by something else, maybe you're not actually paying attention to the right topic. And so we think that the really important topic is how do you construct portfolios and how do you avoid these impact inconsistencies when you do that. So with that, I'll hand over to Eric to discuss how you can actually avoid these issues.
Thank you, Felix. Okay, so our first message is try to keep it simple, try to avoid complexity. And we have here a quote by the famous British statistician George Box, who basically says that complexity and overfitting of a statistical model is often the mark of mediocrity. And what we have seen in some of these products and climate strategies out on the market today, which Felix also gave an overview of, is that they often are extremely complex. Some of them have more than 10 different objectives, constraints, data inputs at the same time in the way they construct the strategies. And this from a purely, let's say, robustness, the perspective of the robustness of any kind of a statistical model is a critical sign. It's a sign, something you should worry about for any kind of statistical model. But it's even more important when it comes to strategies that aim to have a climate impact. As Felix said, this is the perspective we have in the discussion today, is how to have an impact on climate change. And from that perspective of impact, it's even more important to keep it simple, because basically your goal is to have an impact by influencing the behavior of company managers. So you need to have a dialogue, you need to make them understand what your goal is. And if you want to be understood, you need to keep it simple. And you also need to be transparent. You need to explain to them what you are expecting of them. This is, of course, sounds a bit obvious, but when it comes to investment strategies that seek alpha, for example, transparency is not always a criterion. Actually, if you seek alpha, you would probably prefer to be completely opaque. You would not share your secret sauce, your alpha driver with other investors, and you would not necessarily share them with company managers either. You just want to keep that to yourself. So opacity might be good for alpha, but if your goal is to have a climate impact, opacity is not a good thing. On the contrary, you need transparency. And when it comes to simplicity, we believe that there is a clear need for convergence on a limited set of different data inputs, on a limited set of goals. And because basically, if you have 100 different investors each come up with a dozen different metrics, a dozen different goals, and they all come to the company managers and tell them what they expect. Basically, the company managers will be faced with 1,000 different different objectives, and the most likely outcome, if you're faced with 1,000 different expectations, is that you're not going to meet any of these expectations. So it's much better if investors converge through investor coalitions, and also to some extent through regulations, that you converge on a limited number of inputs and goals. So our first message is clearly parsimony, simplicity, and what come with that in terms of climate impact: transparency and predictability, and convergence around a limited number of inputs and goals. Now, more specifically, if we go to the next slide. There we go. So some more, let's say, practical recommendations when it comes to portfolio construction. The first one, and this kind of attention point is actually not so much addressed to the product providers or to the asset managers, but more actually addressed to asset owners. And this is that you should not be obsessed with tracking error if your goal is to tackle climate change. Basically, we know that to tackle climate change, we need huge investments, we need huge changes of capital allocation. And this means that the economy, the future economy, will have to look quite different from the current economy. So basically, putting a constraint that the investment portfolio should look very much like the state of the current economy, which is basically what you're saying. If you want to have a very minimal tracking error budget, this is not going to be helpful if you want to achieve climate impact goals. So asset owners, when they basically ask providers and asset managers to design climate strategies, they cannot at the same time expect significant climate change impact, and at the same time put very strict tracking error constraints. This is actually completely inconsistent. The second recommendation in terms of portfolio constructions is about the question of signal consistency. And Felix mentioned, let's say, the worst example of signal inconsistency, which is the increased weight or the increased capital allocation given to companies with deteriorating, worsening climate performances. So be careful when you construct portfolios to have this consistency at stock level between the climate performance and the capital allocation, i.e. the weight in the portfolio over time. And this is important because basically when, just to give a counterexample as well, when an investor sits down with the company manager and engages with the company managers to try to improve the situation, basically, the company manager don't care about the average carbon intensity of the portfolio. This is, as Felix just showed, some of these strategies achieve 80% carbon intensity reduction on average in the portfolio. But that's not really what the company manager cares about. They care about what the investor is doing with their specific stock within the portfolio. And as Felix also showed, there can be complete inconsistencies when you try to drill down at stock level and see what these investment strategies are actually doing. So you need to make sure that for each company, there is a clear link between the climate performance and the improvements in climate performance, the climate efforts, and the capital allocated to that specific stock. And thirdly, as Felix also mentioned, you need to care about the capital allocation given to sectors, and in particular sectors which are key sectors in terms of the climate transition. And the example that Felix gave was the electric utilities, where we need huge investments in particular into renewable energy. So we need more capital we need in this sector. So withdrawing capital from electric utilities in aggregate is actually counterproductive from a climate perspective, even though, of course, it's a very simple way of reducing the current carbon intensity of the portfolio. Now, quickly, I'll just look at some of the portfolio construction steps that we apply to scientific betas, climate impact strategies. There are two columns here because one is the standard methodology, the other is compliant with the regulation of the EU Paris-aligned benchmarks. But they are very similar, and as you can see, it's a stepwise approach, and this means that they're more transparent than, for example, an optimized approach where you put in all the different inputs and all the different constraints and solve that in one go through an optimizer. It's a stepwise approach, which makes it more transparent and also then more predictable for company managers. And I'll just focus on the three first steps. In the first steps, we have a filtering approach. We take away some of the worst companies in terms of stranded asset risk and which have business models most incompatible with any kind of a net zero trajectory. So we take away, in particular, coal companies and tar sands related companies. But the second step is probably the most important. And this is, once we've taken away the worst coal and tar sands companies in particular, we want to have within sectors a weighting scheme that makes sure that the weight of the company is directly linked to its climate performance within that sector. So we make sure that within sectors, companies with better climate performance receive a higher weight. And this also means that over time, companies with improving climate performance get an increased weight over time relative to their sector. And in the third step, because this is an intra-sector weighting approach, then in the third step, we make sure that we are neutral in terms of sector allocation, in particular to avoid some of these sector biases that we mentioned in terms of electric power companies in particular. Now, I mentioned that we weight stocks given their climate performance. So how should you assess the climate performance of a company? And as I said, some product providers have extremely complex approaches. They use a large number of different metrics. They use some sophisticated proprietary climate risk metrics, for example. And instead, we argue that it's better to have a lower number of targets, and in particular, preferably using some of the metrics which have been recommended by investor coalitions or instances or like the TCFD or the regulations like the EU taxonomy regulation. So what we do is we start with carbon intensities and we stick to scope 1 and 2 divided by revenues carbon intensities. And that is simply because we want to avoid scope 3 data as long as the scope 3 data is modeled. And the reason is, if you use model scope 3 data, it means that you don't take into account the specific idiosyncratic efforts made by each company manager. And if you basically judge somebody on a modeled assessment which doesn't reflect what they're actually personally doing, it's very unlikely that they will feel that this is a reward mechanism or an incentive for them to act. So try to avoid model data, and therefore, as for the time being, we avoid using modeled scope 3 data, even though, of course, there are limitations to scope 1 and 2 emissions. We complement that with green revenues data, and we prefer to use, let's say, common definitions of what constitutes green revenue. So in the future, we'll have data which will be more closely aligned on taxonomy regulations, in particular the EU taxonomy regulation. We also want to have, because we are fully aware that, let's say, using current or what you could even consider to some extent backward-looking scope 1 and 2 emissions data is not ideal. That ideally you would have a more forward-looking approach, looking at the trajectories of companies. And one way to address that is by using data from the Science Based Targets initiative, which is, let's say, a common publicly available database where companies submit and can, if they are sufficiently credible, get their forward-looking decarbonization targets approved. And then lastly, we look at whether the companies disclose themselves the carbon emissions data or not in order to incentivize better disclosure of emissions data. Now, basically, that was our recommendations in terms of portfolio construction, and I gave you a very quick overview of how we would construct climate impact strategies that try to address or try to maximize the potential for impact on climate change. And in summary, we basically want to have something which is simple. Stop mixing everything up. Stop mixing a host of different targets and constraints and goals. In particular, for example, mixing financial targets such as minimizing tracking error together with trying to maximize climate impact. And don't believe that basically by trying to address, for example, some financial objectives in terms of alpha gathering, that basically climate impact will come as a byproduct of that portfolio construction strategy. So if you want to have a maximized impact, try to basically have capital allocation decisions which are clearly linked at stock level to the climate efforts made by companies. Avoid some of the sector biases, in particular underweighting electric utilities, and keep things simple. So that basically sums it up. We will now go into the Q&A, and before that we'll have a poll question to see basically whether on one of these issues that whether you agree with our view or whether you have a different opinion. So we'll go into the poll now.
We will indeed. Thank you, Eric, and thanks to your neighbours for choosing this moment to do some DIY. So that we have the polling question, it should be up on your screen now. I'll just read it out. Which of these statements do you agree with? Firstly, having a larger number of climate data, metrics and goals better reflects the complexity of climate change, or alternatively, investors will be more effective in fighting climate change by converging on a smaller set of metrics and goals. So if you could pop in your answers right now, we'll come back to the hopefully get some results in a minute. Whilst we're waiting on those results, I just want to, there's been one question I noticed in the box asking for a definition of taxonomy. I would say a system of classification. So would you agree with that?
Yes, that's exactly how I would also describe it. So yeah. It's just the process of classifying things, and in this case, we're just interested in classifying the portfolio construction methodologies that are used in climate investing.
And we're seeing, and maybe come back to this in a minute, but we're certainly seeing a drive towards sort of standardization of that. I think it's fair to say in Europe and in the UK in the near future. So certainly all worth discussing. So I think we have the poll results. Can you see the results? Is that up on your screens? So we have an outright winner, which is investors will be more effective in fighting climate change by converging on a smaller set of metrics and goals. Do you have any initial responses to that? Is that what you were expecting?
Yeah, I wasn't expecting that much, but it concurs with our view. I mean, basically, in particular, well, we come from let's say a research house with research institutes which have been working with statistical models. So this idea of parsimony is something that we don't only apply to, let's say, climate investing, but it makes even more sense for climate investing to converge on a lower number of indicators. And I think these regulatory initiatives, in particular the taxonomy regulations, are very helpful in moving us in that direction. And also the investor coalitions such as the IIGCC, for example, are helping move investors in the right direction. And even though there are a large number of initiatives, let's say the IIGCC, and you have, let's say, the TCFD, etc., so it sometimes feel like there's a host of different initiatives out there. But one good thing is that they try as much as possible to relate to each other and avoid duplications of methodologies. So, for example, in the IIGCC's net zero investment framework, which they built together with the investment coalitions in the US and also in Asia. So they try to make it into an even more global approach. They, for example, refer to the EU taxonomy regulations when it comes to definitions of what they call climate solutions. So all these different initiatives, the coalitions try to work together and to refer to the developments made by each other. So of course, climate change is complex. There are different issues that need to be addressed, but I think things are moving in the right direction when it comes to having some kind of convergence in terms of metrics and methodologies.
Yeah, I would certainly say we see that, I mean, having in the policy team, we've just been working through the various TCFD consultations, and the lack of alignment, shall we say, around some core metrics on the various different consultations has been some of a concern to us. So hopefully we'll all get better at that. Just to say at this point, if you do have any questions, hopefully you can pop them in the box. It should be on your screen there. I'd certainly have lots of questions, so I'm going to start with those if that's okay. So firstly, one thing that struck me when I was watching that is that these issues are obviously very complicated. There's a need for nuance. One area at which we sometimes don't see a lot of nuances in relation to fossil fuel investment or divestment, perhaps. I just wonder, you sort of, I noticed the phrase stranded asset risk was used during your comments, Eric. I just wonder, what's your views on the sort of debate around fossil fuels, and do we consider this in the same light as, for example, electricity companies, or are they a stranded asset risk that ought to be excluded?
So it's a difficult question. So I think everybody agrees when it comes to fossil fuels that in particular coal and to a large extent also the tar sands related companies basically should be excluded because they need to be phased out so quickly that it makes sense to exclude them from portfolios even now. The question is more relating to other oil and gas companies, in particular those that make efforts in terms of investing in renewable energy. So basically some oil and gas companies, more diversified oil and gas companies, which are on a trajectory which is more compatible with net zero goals. So our for example, in the regulated EU Paris-aligned benchmarks, basically there are some thresholds and definitions when it comes to exclusions, but basically in practice, all fossil fuel companies are excluded from EU Paris-aligned benchmarks. And our house view is that this is a bit too broad brush, that basically for oil and gas companies, except for coal and tar sands companies, it makes more sense to stay invested in them, as long as you are very clear in favoring those companies which are doing the most investments in renewable energies, and those also, and we should not forget that too much, those that invest in having cleaner production processes, for example, avoiding more flaring or venting. So as long as investors are very clear about favoring those oil and gas companies which make the most efforts, there is clearly an argument for staying invested in them and accompanying them in their investment efforts towards something which is compatible with net zero frameworks. But on the other hand, if basically investors say, okay, we'll stay invested in oil and gas companies, and what we'll do is we'll engage with the sector and try to push them forward, and we won't change anything in our investment portfolio, we'll just sit down and talk to them. I don't believe that that is a very credible approach. We clearly believe that at this point, the engagement needs to be backed up by real investment decisions and clearly favoring those companies making the most effort. So not necessarily excluding them, but clearly making capital allocation decisions which favor those that make the most efforts.
Thank you. Sorry about that. My sound completely disappeared for a minute there. So apologies, I would have interrupted you when everyone else could hear and I couldn't. I just want to ask another question, if that's okay, around something that came up in your presentation. You referred to investment coalitions and the need to converge around specific goals so that companies are clear as to what they're, what is being expected of them. I think you used the phrase either through coalitions or through regulations. I just wonder, I mean, you referred to a few there in your earlier answer. I just wonder, do you have a view on how investors should sort of go about that? Do you see it just being a sort of patchwork of different organizations and different coalitions? Do you see a role for government? What's your sort of views on how we can all be a bit better at that?
I think the most important coalitions, basically one is around the net zero investment framework from the Paris-aligned investment initiatives, which brings together the IIGCC, the AIGC, and the N-Series in the US. So they are themselves making the efforts of gathering the investment coalitions around them. As I said, they, in their framework, they refer, for example, to the EU taxonomy regulation when it comes to defining climate solutions. And for example, they also link up to the Net Zero Asset Owner Alliance target setting protocol, because basically in terms of setting targets, the recommendations from the Net Zero Asset Owner Alliance are also relevant for the Paris-aligned investment initiative framework. So I think basically they work quite neatly together. They do make efforts to refer to regulations when regulations are forthcoming, etc. So I think it might feel like there's a lot of the different initiatives, and that there's a bit too many of them, but I think they're actually making a good effort of linking up together and moving, let's say, together in the right direction. And they're to some extent complementary. So the regulation will focus on them, let's say, more technical definitions of what constitutes green revenues or climate solutions. Net Zero Asset Alliance will focus more on target setting. The Paris-aligned investment initiative, let's say, more on portfolio construction and also assessing company assessments at company level. So they're actually quite complementary, even though, of course, there is a lot of complexity.
Indeed, yep. If I could ask you, so during the presentation, you sort of argued that including market caps effectively drowns out the ESG weighting. I just wonder, would you worry that there might be alternative impacts on that, for example, that portfolios might be illiquid?
So it's true that's, let's say, the main benefit of having something which is market cap weighted or strongly tied to market cap weighting is the inherent liquidity, because basically market free float is a, let's say, a proxy for liquidity, and also the turnover will be very low because you just let the weight in the portfolios float with the market prices. So let's say both in terms of liquidity and transaction costs, it's let's say optimal. But that's probably the only good thing that you could say about market cap weighting. And as soon as you stray away from market cap weighting, yes, you will have liquidity issues coming up. Now, in our portfolios, we deal with that. So we have some caps, etc., in terms of weighting to ensure liquidity. And we have experience, let's say we've been building factor indices or smart beta indices for a number of years. And what we see is that these climate strategies that we designed, even though we just have put some simple cap weights, these indices are about twice as liquid as the factor indices. So they are inherently more liquid than, let's say, more quant-driven financial strategies. And so that's from a liquidity perspective. But I think another big benefit of straying away from a market cap weighting and having a weighting which is clearly linked to climate performance is that you will avoid some of the concentration problems that you have in cap weighting. You will have something which is not equal weighted, because equal weighting is not a way of constructing a reward mechanism or an incentive. So you need to, if you equal weight, you don't have any reward anymore. But if you have something which is more deconcentrated, and this is something you get as soon as you move away from a market cap weighting, you will have better diversification properties of the indices. And this is actually something to make this idea about everybody understands theoretically what diversification means and deconcentration means. But let's say in practice, a good example is what happens to the large tech stocks in the US lately. So a lot of climate strategies, let's say if you start with a US market cap weighted index, You will have the GAFAM stocks as the top, in the top 10. You will basically have all of the tech giants. So you will concentrate a lot on tech giants in any kind of market cap weighted approach. And if you do a tilting approach where you overweight, let's say, low carbon intensity stocks relative to the cap weights, you will typically overweight these same tech stocks. So you will be even more concentrated in these tech stocks in the US. So if you're worried about concentration problems, in particular in the US, in general, you should be even more worried about concentration problems in climate strategies, because they tend to be even more concentrated, in particular, for example, on these US tech stocks. And so one benefit of moving away from market cap weighting is better deconcentration, better diversification.
Thank you. Just one more question, if I may. It's a wee bit of a naughty one, but I've sort of read, I think, Felix, before you've done some work on the performance of ESG tilted stocks, and your conclusions were that although they have to date outperformed non-ESG funds, you don't necessarily, that's not necessarily because they're ESG, there's other factors at play. I just wonder if, if we move forward and the reverse turns out to be true, I just wonder where would you see that would leave investors, particularly, smaller pension scheme investors who are maybe invested in pooled stocks and so on.
Yeah, so in terms of the performance, so we looked at research mostly looking at the long-term performance of ESG and also low carbon strategies, and what you see is a very strong relationship with traditional performance drivers. So in particular, profitability, and so you get especially over the past decade, you got a strong boost from the profitability exposure of the ESG and low carbon strategies, and of course the point is you could have achieved that same result by following a quality strategy, quality equity that tilts to more profitable stocks, and so in that sense, there's no need to actually use ESG information to have that. So that's on the long-term performance. Of course, if you go forward, that result could change in different ways. I think the link with profitability is quite structural. So there's actually lots of evidence also at the firm level that there's a positive link between profitability and ESG performance. And there's some debate about whether there's some causality, and if so, what's the direction? So is it that firms that are more profitable can make more effort on ESG, or is it something else? So if that link is structural, you would actually expect that to remain positive. But of course, there can be extended periods of time when high profitability firms could underperform, and if that's the case, then of course this whole motivation of using ESG or low carbon strategies because of the performance will break down, and actually there's good reasons to believe that this underperformance, for let's say periods of 5 to 7 years, is actually quite likely, because by tilting to this profitability factor, you're getting performance only from one performance driver. So as investors know, if you're actually getting exposure to such a factor, it can be highly cyclical, and that's why investors are looking for financial performance. They are actually usually combining different factors. So you could really have a kind of let's say negative performance of these strategies, not because there's something wrong with the ESG analysis, but simply of the low carbon analysis, but simply because you actually may have a negative performance of low profitability over an extended period of time. So that can happen as with any factor strategies. You also have other short-term influences of this, which sometimes are maybe a bit counterintuitive. So for example, we have conducted an analysis of low carbon portfolios, and we see that there's quite a strong short-term impact of fossil fuel prices. So since a lot of these low carbon strategies actually filter out fossil fuels, so when actually fossil fuel prices decline, you will actually have a kind of performance boost to these strategies. But I think this is where it's important to distinguish between these financial objectives and the impact objectives. So for example, if you're an investor who's worried about the climate, you could say you're very happy about the performance of your low carbon strategy when fossil fuel prices, go down. But obviously the fact that fossil fuel prices go down is actually very bad news for the climate, because we know that in order to have this transition, people have to pay more to emit CO2 and use fossil fuels. And so I think it's just important to separate these, financial objectives and impact objectives.
Absolutely. Well, thank you both. That was a really interesting presentation. Thank you to everyone who has attended and who took part in the polling and so on. Apologies once again for the interruption of Eric's neighbours and my headset failing. We have more webinars coming up this autumn. We've also got our annual conference coming up that starts the 12th of October. I hope everyone will sign up, and I look forward to seeing you there. Thanks again.